Good evening, everybody, and welcome again to this September edition of the Monthly Market Insight. Delighted to have all of you join us again in this monthly webinar. And as usual, we will be covering aspects related to the economy, markets, valuations, and as usual, we will also have one particular strategy that will be discussed. And today I'm delighted to have Vishal Chopda, Fund Manager at UTI Mutual Fund, join me in this webinar. And he'll be talking about the strategy that he manages on the Focused Fund. He's also, of course, the manager of our tax fund, the ELSS offering, and the consumer fund. So, any questions you have on any of these strategies, we'll be happy to take that. And of course, I'm here as well throughout the webinar. So any questions that you have as regards the markets or any of our other strategies, we'll be happy to take that up in the Q&A. So without any further ado, I'll just request my colleague Niranjan, who has put together the deck as usual, to put it up on screen, and hopefully that's now visible to you, the equity market insight. So without any further ado, let's first dive in. And as you know, what we've been doing of late is essentially every month highlight some of the topics which might be of interest to you, or some of the macro trends that we are seeing, which we believe are important. They are shaping the way this economy evolves. And, hopefully by sharing these insights with you, you also will be better informed about these trends. So on the left-hand side of this slide, what we are doing, so again, sorry, just to pause, but the larger context is that today we're going to be looking at India's services trade. Now, on the left-hand side, what you have is the growth in India's services imports and exports, and you can see this over three periods. 2012 to 17, 17 to 20, and then from 20 to 23. Now, what you can see over here is that India's overall services exports, which were growing at about 3% per annum from 2012 to 17, accelerated to about 11% per annum from 2017 to 2020. So going into the pandemic, there was already some acceleration in growth in services exports from India. And then through the pandemic until 2023, you see a further acceleration in services exports, which now rise to almost 14% CAGR over that 3-year period. So, that's the sort of trajectory that we have in terms of overall growth. And you can see that again on the right-hand side. But on the right-hand side, what we've also plotted, which is that black line, is the total value of net services exports from India. So this is services exports minus services imports, and that net number is now up to $200 billion per annum. So net revenue of $200 billion per annum is earned by services exports from India. And just to clarify, this includes not just the amount booked as services exports, but also includes the amount which comes back to India by way of remittances, because some services could be delivered by Indian citizens sitting in different geographies across the world. They're earning over there, but they're sending that money back home from after receiving their salary. So this number that you see is the net of both the services exports, including remittances, and that number is now $200 billion per annum. So while many of us are now looking forward to India's potential success in manufactured goods exports over the next decade, what we must recognize when we look at this chart is that we've already created a very significant service export engine in India. We'll move on to the next slide. And here what we've done is we've just shown how India appears to have now, using services to significantly ramp up its growth rate and share of what we call modern services. So when you think about services, there are many services that can be provided, but typically modern services includes, the technology services and things which are provided virtually, whereas traditional services could also include things like, for example, freight services or some services earned for very low value added work. So what you've got on the left hand side is we are looking at the growth in total global sales. What is the growth in modern global sales? What is the total growth in services for India? And what is the growth rate for modern services? Now, when you look at the left hand side, you'll see that the light gray bar is now the fastest growing bar, which means that modern services are growing faster than total services. And in India's case, modern services are growing significantly faster than total services. So remember, total services are growing at 14%, but if you see modern services, they are actually growing at something like almost about 16.5, 17% per annum over the last 3 years. Now, what is the impact of this? You can see that on the right-hand side. We've plotted two numbers over here. One is what is India's market share of overall services and what is India's market share of modern services. So both lines are rising. Today, India accounts for about 4% of total, little more than 4% of total services. But if you look at modern services, we are almost 8% of modern services. So, you're just slightly shy of double digits. And this certainly makes India a services powerhouse in the global economy, because it's very rare to find economies where their share of either goods or services starts to punch about double digits. We are not yet at double digits, but given the recent momentum, there's every reason to believe that this is something which now looks very imminent. So India is certainly on the services side now starting to demonstrate its heft in the global marketplace. Finally, we'll just move to the next slide, again talking about the same thing. Now, all of you are very well aware, of course, that India has always had a trade deficit problem, because as you know, we import our oil because we are not self-sufficient in oil. Indians also have a love affair with gold. We buy a lot of gold and all that gold has to be imported, and gold also gets counted in the trade deficit. So India has always had a large trade deficit. You can see India's trade deficit plotted in the dark black line in the chart which is visible. You can see in about 2013, the trade deficit had reached about $200 billion. During the pandemic, the deficit then drops to about $100 billion. And then at the end of 2023, the 12-month trade deficit rises to almost $265 billion. So remember, India is approximately almost a $3.5 trillion economy. So when we talk about a 265 billion goods deficit, it means that our trade deficit in terms of goods is almost about 7.5% of GDP. But what is also visible in this chart, we have shown two lines. One is the services export line and the other is the invisibles line. What is the invisibles line? This is nothing but the remittances. So Indians who are working overseas, somebody could be working maybe in the labor sector in the Middle East. They could be working as IT engineers in the US or in developed markets. They could be working in banking and finance or any other sector somewhere else in the world, and they are sending remittances back home. So that gets counted in other invisibles. Now, the interesting thing is that because this overall services number is growing at a very rapid pace, it is certainly growing faster than the deficit in trade. What we have on this slide is a potential forecast which shows that if the continued rate of growth of about 16 to 17% in modern services continues, then it's very likely that by the time you get to somewhere around 2027-28, the total surplus from services and other invisibles in India will almost be equal to the goods trade deficit of 2023. No doubt the goods trade deficit may also increase over the next few years, even though we are trying to curtail that by increasingly manufacturing in India. But the strong growth in services more than anything else makes it very likely that somewhere in the next 4 to 5 years, India's goods deficit will more or less be completely offset by the services surplus. And this will be the first time in India's history where this would be happening, where the goods deficit and the trade surplus from services would more or less balance each other. And we've often talked about India's challenges on the current account deficit. That would perhaps then not be such a critical issue, because India's export prowess would have finally overcome what has typically been a historical problem and challenge for India. So this is what we wanted to share with you, that clearly India has found a new momentum in terms of services exports. This is essentially coming from what we call modern services. Many of you may ask me, what is modern services? Is it only IT services? No doubt, a significant part of modern services is IT services. But increasingly, what we are seeing is the rise of what NASSCOM calls global capability centers, which means companies which could include the likes of a Daimler-Benz, which makes the Mercedes-Benz. You have companies like Walmart, like Lowe's, all of whom have very large centers in India. And these no longer are doing only IT services. They could be involved in everything from, social media communication to human resources, back office functions, analytical functions. So pretty much all functions that a company needs, which can be done virtually from a distance, are now being done out of India. So it is actually these global capability centers which are the ones which have particularly accelerated in terms of growth over the last 5 to 7 years. And this is what is lifting the overall trajectory of services exports from India. And potentially we could be looking at a situation 4 to 5 years later where the goods deficit in India is completely offset by the services surplus. So that's the key message in today's webinar. Moving on very quickly, we'll now run on to some of our more regular slides. This is largely data. You will receive the presentation and you'll be able to look at this yourself. But I'll just highlight one or two key things, which is that if you look at bank credit, the growth is now continuing at almost about 13 to 14%, which suggests a reasonably healthy level of activity within the economy. And when you look at gross tax collections, it continues a healthy trend, but there is some sort of overall slowdown visible. Partly it's also got to do with the fact that, remember, that the taxes tend to be driven by nominal GDP and nominal revenues, and nominal revenues on a year-to-year basis are now slowing. Nominal GDP was only 8.5% in the first quarter of this year, and that is translating into much slower revenue growth for the economy, and therefore tax collections in nominal terms are going slightly slower, and that will lead to some challenges for the government in terms of managing the fiscal deficit. But we continue to believe that the government will target that 5.9% number for the year. So moving on, we'll quickly look at how the earnings picture is shaping up. So if we just jump through to the earnings section, here we are. So the estimate is that earnings would grow about 19% in the year ended March 24. Now the earnings are already in for the quarter ended June 23. Earnings have actually grown 32% year on year in this quarter. So you could look at that number and say, oh, if it's grown 32%, then what's the challenge in achieving 19% for the full year? The challenge is very simple. Remember, first quarter last year was the quarter in which the Russia-Ukraine conflict had really disrupted raw material supply chains, raw material prices, and in general supply chains. And therefore, companies had severe margin pressures during that quarter. So when you look at the first quarter of this year, what you're really seeing is a rapid margin normalization. It's not really coming from revenue growth. But as you work your way through the quarters, the benefit from margins will start to vanish, and nominal growth being only about 8% for the current year would pose some challenges in terms of delivering that 19% number. So I would certainly say the first quarter has been quite satisfying in terms of the performance. It sets us up well, but I still think 19% for FY24 remains a little bit of a challenge. Moving on to the next slide. You can see over here the trend. Just look at those middle 4 bars. That's the estimate for FY24. These are the estimates as of June 22, September 22, December 22, and then finally all the way up to September 23. So September 23 estimate is 991. And if you look at the gray bar, which was December 22, it was about 983. So there's about a 1% improvement in the overall estimates over 9 months. But over 6 months, more or less, estimates have remained flat, 992 and 991. So I think, again, was both good news and bad news here. There's no acceleration in expectations of earnings growth, but at the same time, no significant cutbacks. Earnings estimates have been flat. There was a point in time during July, August, where estimates had started to come down, but I think the strong quarter that we saw means estimates are now once again unchanged. We'll jump through now to look at valuations. You look at the trailing P, very much in the comfort zone. You look at the forward P. Remember, last month, the Nifty 50 actually came down even as the mid-cap and small-cap index went up. So even on a forward basis, the Nifty 50 P multiple is below that red line, which distinguishes the expensive area and therefore sort of in the fair value zone. We can also look at the price-to-book ratio, which is on the next slide. And the price-to-book ratio quite comfortably in the white space. Above the yellow line, that means it's above the long-term average, but below the red line, and the red line is really what distinguishes the expensive territory. So above the long-term average, so it's a comfortable zone for investing. It's not necessarily attractive. Many of you would have heard us talking about the balanced advantage fund and the model that is driving our balanced advantage fund. And in the range of equity allocation that the fund can have, which goes between 30 to 90%, the fund's allocation to equity is exactly in the middle, which is at 60%, which means it's comfortable, but it's not great. And that's why we are, sort of in the middle of that allocation range at 60%. ROE, we've talked about it in the past. Nifty 50 ROE, best that we've seen going back almost about 10, 12 years. And that is why the price to book is much higher than what you see in the past. So that's something also to keep in mind. Now, moving on to the next slide, we've got the Nifty mid cap and the Nifty small cap. Now, this is something which is quite remarkable. It was not my base case 3 or 4 months ago that the small cap index had so much room to rally, but the small cap has had a tremendous rally over the last 4 to 5 months. But to my mind, it's also created a very significant valuation challenge. Look at those valuations. It is now very comfortably in the expensive zone and at a premium to the Nifty 50. Even mid caps, which otherwise were slightly more comfortable compared to small caps, have now pulled into that red zone. So, I think when I look at the valuations today, our real comfort is with the large cap area. Small caps and mid caps, certainly from a valuation point of view, they've got tremendous momentum behind them, but this is where you have to worry that if anything causes that liquidity to reverse, these valuations will not provide much support to the stock prices. So moving on, we'll quickly jump through. We've already sort of covered most of this ground, so I'll just move to the summary slide. So I think the real surprise continues to be the strength of the US economy. We discussed this last month as well. Data remains robust. In fact, the US Atlanta Fed publishes not a forecast, but just looking at, high frequency indicators, the indicators that I showed you on that earlier slide on the economy. So the Atlanta Fed looks at some of those indicators and then based on that triangulates a potential GDP outcome for the current quarter. That number is currently tracking at above 5% for the current quarter, which is quite remarkable when you think that interest rates in the US have gone from 0 to 5.5%. And the Atlanta Fed now indicator of GDP, again, it's not a forecast. They're just triangulating based on data points, but it is saying their economy can actually grow at 5% in the current quarter. And that's quite mind-boggling. But I think that is the other reason why, inflation has declined, but it remains well above the 2% target. And even yesterday, we saw the Federal Reserve governors talk about the fact that, they are happy continuing to hold rates up. They haven't ruled out a potential rate hike, but in the September meeting, certainly they seem to be indicating they are not in in a hurry to hike. They want to see some more incoming data, but certainly they don't see any scope for a cut in rates in the near future, simply because the economy itself is so robust. Now, in India, the MPC has kept the policy rates unchanged, pretty much in line with expectations, and they have continued to talk the language of withdrawal of accommodation. Food inflation has spiked significantly, 7.44% July CPI, driven primarily by the spike in food inflation. But I think now the MPC is taking a view that they have to look through the spike in food inflation, because underlying trajectory of economic growth does not show this kind of momentum in CPI. And secondly, there is still concerns about the strength of the global recovery, and that global headwinds might eventually suppress Indian growth. And to that extent, therefore, the MPC prefers to be on hold. As far as earnings are concerned, we've already talked about the strong performance in Q1 and the fact that FY24 estimates are unchanged, and why I still think there is some risk from those numbers. There is a dichotomy in terms of valuations, the Nifty 50 trading in the comfort zone, whereas the Nifty Mid Cap 150 and the Nifty Small Cap 250 are much richer. They are trading at a premium to large caps, and that does give some cause for concern. Investors should adopt a staggered approach to equities, continue your SIPs. You could also use the STP route to invest. And of course, the other alternative that you have for investing is to look at strategies like a balanced advantage fund or a multi-asset fund, where we are running a model internally, and based on valuations, we determine what the allocation to equity should be. So, that's the kind of strategy where you could make lump sum investments. But if you're looking to invest in more traditional equity-only funds, the pure equity funds, then do consider a staggered approach. So that's about it from my side in terms of a wrap on the market. I'll pause over here and hand over to Vishal, and he'll talk about the strategies that he manages. And then finally, we'll come back and cover the Q&A. Over to you, Vishal.
Thanks, Vetri, and good evening, everyone, for joining on this webinar. So today I'll be talking about the strategy of UTI Focused Equity Fund. Next slide, please. So as everyone is aware, the biggest difference in a focused equity fund versus other diversified equity funds is the concentration of the portfolio in terms of number of stocks. So the portfolio has less than 30 stocks, which means that we are trying to handpick high conviction ideas, have much higher weight in each of the ideas we have, and so that the number of ideas are limited to less than 30, unlike other diversified equity funds which at least have 50 or more ideas in the portfolio. So what it leads to is that the portfolio is quite unique when you compare any focused equity fund or the UTI focused equity fund to its benchmark or the broader market. Generally, if you look at our focused equity fund, the active share is around 71% today, so it will have a high active share given the concentration, which will mean a possibility of generating much higher alpha. So the portfolio has the ability to deliver much higher returns, and obviously the risk is also higher compared to other diversified equity funds. What we try to do to reduce the risk or the risk and diversify for more is we try to have our portfolio diversified across most sectors and market capitalization. And as I will explain ahead, in terms of style, the investment style also, we try to minimize the concentration, basically offset the concentration risk by taking other measures. So it's a combination of large cap, mid and small cap, but given that it's a concentrated portfolio and liquidity is also important, it tends to have around 75 to 80% in large cap and balance in mid and small cap. And lastly, again, I want to highlight the research expertise we have, which we are able to leverage when we are running this kind of fund. We have around 12-member research analyst team. Some of the senior research analysts have more than 10 years of experience. So that helps us significantly in deep diving in our ideas and having the conviction to have higher weights in those ideas. So what the investment strategy of this fund is to run the fund with a blend style. because we are already running a concentration risk in terms of number of ideas and the weight per position, we try to minimize that risk by not taking any significant style bias, having any significant style bias. So in this portfolio, we run with a blend of both growth and value, and we achieve that by identifying ideas across three buckets of opportunities. So the bulk of the portfolio or the core of the portfolio, I would say, sits in the sustainable businesses bucket. I would say 60 to 65% of the portfolio will sit in this bucket. One can also assume this is more akin to the growth style of portfolio, the growth bias of the portfolio. In this bucket, we'll try to invest in companies in which we feel there is a long-term sustainable growth, companies which generate healthy cash flows and good return on capital employed. The second bucket will be the cyclical opportunities bucket, and we might have 20 to 25% of the portfolio in that bucket. These are the companies which are in the cyclical sectors like metals, oil and gas, autos, capital goods, where we believe that cyclically either the earnings are at bottom or even the valuations are at bottom, and we think the portfolio can benefit from the mean reversion in those ideas, and we try to capture those cyclical upturn in those ideas. And I would say this bucket largely sits in the value bucket of the portfolio. And lastly, last bucket is the transformation or the turnaround opportunities bucket. This we can find across any sector. I mean, it could be in a commodity sector, it could be in a FMCG sector, or in a banking sector. So this can be sector agnostic. And here again, we are trying to identify companies which historically were doing well, but because of company specific reasons or sectoral reasons or regulatory reasons, the company was going through a bad phase. And if we believe there are some changes happening at company level or at regulatory level, or at sector level, which could lead to a improvement in the profitability, cash flows, or the leverage situation of the company, we try to identify those kind of opportunities and invest in those kind of companies. But this kind of opportunities are not very easy to find. So I would say 15 to 20% of the portfolio will generally you will find in this bucket of the fund. So a combination of the all three kind of ideas leads to a blend of growth and value. But what is equally or more important, I would say, in a concentrated portfolio is what we should avoid in the portfolio, because any mistake here could be a very costly mistake, given that any position will be a sizable position in this portfolio given the number of stocks. So first and foremost, management is of paramount importance. So any company where we have a history of poor corporate governance or any other issues related to dealing with minority shareholders, we try to avoid, or we'll avoid those kind of companies. Secondly, clearly we'll try to avoid companies with very high leverage, and I would say specifically in cyclical companies, even if the cycle in that subsector is looking favorable, we avoid very highly leveraged companies, because if the cycle doesn't turn in our favor, actually that could lead to a big bankruptcy risk or a permanent loss of capital. So very highly leveraged companies is another clear exclusion filter for the portfolio. Thirdly, are the sustainability challenges. So, like many companies or many subsectors where valuations might look actually attractive, but if we believe in the longer term that product or the service which the company is selling might not have adequate market or might have difficulty in growing, we'll again avoid investing in those companies if we feel in the longer term there is no runway for growth for that company. And the last two, I think most of you would be familiar with, are Score Alpha research framework, where we focus on ROC and cash flow. So here again, in this portfolio, we try to invest as much as in the C1 part of the portfolio, some bit in C2, but we try to avoid C3. And similarly, because it's a blend portfolio, we try to have a mix of R1, R2, R3, but we could clearly avoid companies which have been not able to generate even cost of capital through a complete cycle. So that way you will see that bias again here, not willing to invest in very inferior ROC companies. So just to explain it better, what I have done is I have tried to give you an example of all the three buckets. of sustainable businesses, cyclical businesses, and transformation opportunities to give you a sense that what do we mean by these terminologies. So firstly, it's an example of sustainable business. It's one of the India's leading private sector bank. I mean, the largest private sector bank, I would say. And if you look at the longer term track record of last 12 odd years, they have seen a consistent growth in their profitability. Their ROAs and ROEs have been in that region of around 2 odd percent for a long term period. So they have seen best in class loan growth and asset quality, and which led to a very good ROA and ROE outcomes. And that is why we have seen a significant 17-18% CAGR in the stock price in last 10 years. So this is one of the example of sustainable business which we try to find and invest in the portfolio. Second is a cyclical opportunity. So here I have taken an example of the largest four-wheeler manufacturer of the country, and we know that auto and especially four-wheelers can be quite a cyclical business. So we see that in the last cycle, volumes peaked somewhere around FY19, and it was during that same time period and around FY18, EBITDA margins, which you see on the right-hand side, also peaked out. And then we saw a period of 3-4 years of significant downturn in the industry, which led to both volumes coming down and margins coming down. And in last 1 year, now we have started seeing improvement in volumes and improvement in margins, and that's also reflected in the stock price now being almost close to their all-time highs. So this is one example of cyclical opportunity. Here I've given an example of an auto company, but we could find this in metal companies, we could find this in capital goods companies as well. So again, here the idea is that we try to see stocks where they are cyclically low in terms of margins and volumes, and if we see the cycle has the potential to turn around, and again the valuations are not adequately factoring in that upcycle, then we try to capture those kind of opportunities. And lastly is a transformation on a turnaround opportunity. Here I have taken the example of the second largest telecom services provider in the company. As everyone might be aware, around FY 16-17, a new telecom player entered the market, which led to disruptive pricing. And obviously, the average revenue per user for telecom sector, which was closer to say 190-200, dropped all the way to 120 rupees at the bottom. And which also, again, if you look on the right hand side chart, the margins from 40 odd percent dropped all the way to around 20 odd percent. And after that, we saw a significant consolidation in the market. Around 6-7 players left the market, and now the market only has 2 strong players, 1 weak player, and 1 PSU. So you have seen a significant consolidation in the market, and over last 2-3 years, we are seeing ARPUs improving and margins again improving. And we have seen the stock price also, which had seen a significant correction during the hyper competitive phase, now has seen a significant recovery over past 2-3 years. So this is, I would say, one example of a transformation or turnaround opportunity. In this case, it was more linked to the competitive angle, the sector issues. Sometimes it could be just company specific issues, change in management, change in strategy as well. So again, just to give a snapshot of the entire portfolio. So if you look at it, currently the fund is around 2,300 crores of AUM. As I said, the fund is managed with a blend style. So if you look at the price to book multiple of the company, it generally will remain in that plus minus 10-15% of the benchmark price to book. So the benchmark price to book is close to 7 times, while for the fund it's close to 7.6 times. As I mentioned, the fund has a very high active share. Current active share is around 71 odd percent. We have 28 stocks in the portfolio. We can go up to 30 in the portfolio. And on the top right, when you see, as I mentioned, we have a high C1 proportion in the portfolio. So operating cash flow is very important. So 98% of the portfolio is in C1 companies. Well, when you look at the R1, R2, R3, it is little more diversified, given that we are running it with a blend style. So we have 57% portfolio in R1 companies and 32% portfolio in R2 companies. And lastly, the large cap exposure is slightly higher than the benchmark, given the concentration risk in the portfolio. So and because the liquidity constraints we have to manage, The small cap is slightly lower, while we have a decent mid cap exposure in the portfolio. What I'll do now is I'll just run you through what major changes or major changes we have done in the portfolio over last 1 year and last 6 months. So if you look at it, these are the various sectors and the various portfolio weight in various sectors we have in August 22, February 23, and August 23. And on the right hand side, you see the active weight, basically the weight over and above the benchmark weight. So if I have to just talk about few of the sectors where we have done significant meaningful changes, so first will be capital goods. I think clearly we had a very decent weight in the sector a year back, and now and I would say a significant overweight. Over the last 1 year, we have kept on reducing the overweight, and now we are more or less neutral. And the major reason for it has been the valuations, which have significantly moved up, and which we believe have become very expensive, and that's why we have kept on reducing the weight in the capital goods sector. And the whatever names we continue to have in the portfolio, we have been very selective in terms of the visibility we have in terms of order book, and also valuations which we believe are more reasonable compared to the rest of the peer. The second sector I'll talk about is chemicals. A year back, we did not have any exposure to that sector. We have, so I think around 9-10 months back, we added one name in the portfolio in the chemical space. We haven't done anything incremental post that, and no change in last 6 months. We have basically been betted on a name which we believe is doing very well. It's a significant player in the agri CSM market, and now trying to get into the pharma CSM market as well. The next sector is consumer services, where you see we have increased our exposure. In general, we are more positive on the consumer discretionary side of the consumer pack compared to FMCG, given that consumer services have much lower penetration levels, and we believe have much longer and better runway for growth. So we have increased weight in consumer services in companies which have proven and good execution track record, which we believe have underperformed and have seen valuation de-rating over a period of time, and we believe they can continue to do well over longer term. So we have used this underperformance period to increase weight in those stocks. At the same time, we have funded that by reducing our exposure in the FMCG space. On the financial services, the fund was mildly underweight a year back. Now we are at an overweight position. The absolute weight in the obviously the sector is quite high, and there is obviously beyond a point we can't increase the weight, but we continue to remain positive on the sector. I think this is one of the few sectors in the market where valuations are still reasonable, and either at or below long-term averages. So I think the value, one of the few sectors where we still find decent valuation comfort, which is financial services sector. And lastly, in IT sector, so fund was significant underweight a year back. I think around 2 quarters back, where we had seen a valuation correction and valuations were more reasonable. So during that time, we had reduced the underweight and we have added to this sector. But now again, I would say valuations have again inched up. So we are just holding on to our positions in this sector. So the same thing in terms of stock specific. So you will see what I just spoke in terms of sector, how that has played out at the stocks level. So at the upper half, you will see the stocks which we had and which we have exited over a period of time. And the bottom half, you will see stocks which we have added in the portfolio over last 1 year. So, I mean, these are again across the same sectors we already discussed: auto, financial services, FMCG, consumer services, chemicals. So the same sector, I think we have kept on adding. I mean, these are the major changes which we have done in the portfolio in terms of stocks. And lastly, this is the portfolio as of last month at August 31st. As you can see, in most of our holdings, we have a significantly high active weight, except HDFC Bank, because obviously it's a very high benchmark weight, and their guidelines, risk guidelines as per how much we can own in one stock, and SEBI guidelines as well. But otherwise, if you look at it, most other stocks we own, we have a significant overweight position in those stocks, leading to a very high active share of the portfolio.
Yeah, Vishal, thanks a lot for a detailed rundown on the strategy UTI Focused Equity Fund. So now we will move on to take the questions which have come already. And also, I request the participants today so to keep posting your questions related to the fund, UTI Focused Equity Fund, and also on the markets. We will be more than happy to take them for the next 15-20 minutes. So, Vishal, here is the first question to you. So, as you tend to pick some of the unique ideas with high growth potential, right? So, what are the factors which actually influence the position sizing, the weight that you have in a particular stock in the portfolio?
So, I mean, as you said in the question itself, actually, because it's the number of stocks in the portfolio are limited, you can only own 30 ideas. So, first of all, we need to have a high conviction in the name itself in terms of the growth potential of the company, the return ratios, the management quality, the other things which I already mentioned to even enter the portfolio. Then obviously position sizing depends a lot on the starting valuations, at what valuations we are entering the stock, how comfortable we are that. So depending on that, we can start with a higher position size or lower position size. So second is again, because it's a concentrated portfolio, position sizing in a particular idea will also depend on the liquidity available. So liquidity is also a key constraint or a key criteria, I would say, in terms of position sizing. So large cap will have obviously tends to have better liquidity compared to a small cap, so that will also reflect in the position sizing. And lastly, I would say not for every idea, but say for ideas which are very heavyweights in the benchmark, the benchmark which are the top 5-10 names in the benchmark. Obviously, what is the benchmark weight also tends us to lead to what should be the weight of that position in our because we try to have a decent overweight in every idea we own. I mean, except for one idea which I said, HDFC Bank, because of the high weight. Otherwise, we try to have a very good active weight in every individual idea. So also that also leads to the position size of that particular idea.
Sure, Vishal. Thanks. So there is one comment from one of the viewer, Lauda Gupta. So our question is basically, how do you explain the weights in the minus? So primarily, these are the weights where we have underweight exposure compared to the benchmark. So that is what it means. So the positive ones primarily means where we have the overweight exposure in a particular stock or sector. On the other side, the minus values are underweight position. So the next question, I will request Vetri to answer this particular question. So the real GDP in the US has expanded at estimated 2% to currently 2.4% through the first half of the year. So while the business sentiments were downbeat, so resilient consumer spending has been the biggest driver of growth. So on this backdrop, do you think the recession appears to be off the table this year? And are there any visible headwinds which could impact the growth outlook?
Yeah, sure, Niranjan. As I said, Niranjan, the Atlanta Fed's now GDP estimate is actually running at above 5% for the current quarter. So, if you go by that, then the probability of a recession is quite low. Some of you would be aware that Treasury Secretary Janet Yellen was in India last month. And during her visit here, when she was asked by some journalists, she actually said she does not think that a US recession is imminent at all at the current juncture. The Bloomberg consensus still is that there will be a recession in the next 2 quarters. But as of now, none of the data points that we are seeing suggest that we are anywhere close to a recession kicking in. So I'm not very, at this point of time, convinced that you are going to see a recession kick in. Having said that, remember, Niranjan, that a recession can happen because of a shock to the system. I think there are 2 vulnerabilities in the US system. Much like India, their corporate balance sheets are quite healthy. Much like India, the household balance sheets are also in reasonably good shape, partly because of significant transfers made during the pandemic. But I think there are two elements of risk in the financial system. One is the banks. SVB's episode in March, which showed a asset liability mismatch, in a sense was the canary in the coal mine. And while nothing bigger ran into trouble, I don't think we can completely preclude the fact that there is a potential problem. Second thing I would say is that the US government itself, because it continues to run a significant fiscal deficit, unlike most other countries, they are not targeting a reduction in fiscal deficit. I think the government as well, in the US context, is a risk factor to overall markets and sentiment, because they are not starting to bring in the fiscal deficit, and this could have a negative impact either on yields or on inflation, and that will only complicate matters further. So I think there are some risks we need to be aware of. We should also remember that monetary policy acts with a lag. But as of now, Niranjan, once again, to answer the question, if we look at the concurrent data which is coming in, the leading indicators, there is no indication whatsoever of a recession.
Oh, all right. Yeah. Thanks, Vetri, for that. And in the similar lines, there is another question at the US level. So the Fed actually has raised the interest rate in US by 525 basis since last year, March 22. And they are targeting in the range of 5.25 to 5.5% range, right? So, and this has marked one of the steepest rate hike cycle in the last 4 decades itself. So, while the market is premature in its pricing of pivots, so the cutting of rates from the central bank, both in terms of the timing as well as the magnitude. On the other side, what are the likely risks you think would be there to the equity and debt markets amid the deteriorating macroeconomic factors?
Sure. I would say in a US context, as of now, Niranjan, we are yet to see any deterioration in their high frequency indicators. The weakness in macroeconomic indicators is more in Europe and in parts of Asia, including China. In the US itself, none of their indicators are deteriorating at this point of time. The risks, if at all, Niranjan, are that financial markets still seem to be slightly more believing of a scenario in which rates actually start to be cut by the US Federal Reserve quite early next year, whereas what the Fed governors are telling us is that given the strength of the economy, given that our target is to bring inflation down eventually to 2%, rates are likely to remain higher for longer. If rates remain higher for longer, interest rates are like gravity on stock prices, because we've talked about this earlier. A company's value is nothing but the value of the cash that it generates over its lifetime. If interest rates are higher, the discounting rate that you use is higher, and therefore the value of that company has to come down, everything else ceteris paribus being the same. So that, I think, is, to my mind, the challenge. Rates stay higher for longer. Bond markets get disappointed by that, and even equity markets, if they were expecting rate cuts, could get disappointed by the fact that there are no rate cuts. But I think the first point, which is where equity markets maybe are taking solace, is that things don't seem to be going south in the first place. So why worry? The worry, if at all, as I said earlier, Niranjan, is about the banking system, because this sort of a sharp rise in rates, we never know who could be found vulnerable in such a situation.
Sure. There is one question coming from Deepantu Chaudhary. Again, this is a question to you, Vetri. So, looking at the 7.4% inflation and poor monsoon driven imminent food inflation, so can we see RBI to still hold the rates or hike it slightly?
At this point, our bias would be that RBI is not in a hurry to act in terms of pushing rates higher. If you look at all the commentary which came out from RBI, as well as the minutes of the previous meetings which we have seen, it's pretty clear that there is a strong opinion within the MPC that they should look through the current spike in food prices, because it is unlikely to fully transmit through. And remember, they are also concerned that some of these global headwinds, particularly in non-US geographies, could eventually result in slower global growth and therefore, a sort of downdraft on our domestic growth aspirations. So, which is why, I think the base case would remain that we will stay in pause mode. I also think this is a good time to touch upon another aspect, and I think the finance minister talked about this as well last week, that we must stop thinking that monetary policy is the only solution to pressures within the economy in terms of inflation. And particularly, this government has shown itself to be quite activist on this front in terms of intervening in markets, whether it is in terms of a ban on exports of agricultural produce, whether it is change in stockage limits, whether it is interventions in terms of bringing in products from outside to essentially try and cool down inflation. So they are tending to use a lot more methods and not rely purely on interest rates to try and suppress inflation, particularly given that we all know that food inflation can not be directly targeted by monetary policy.
Sure. Thanks, Vetri. There are a few questions on the sectors, so I will request Vishal to answer them. So, Vishal, you mentioned in your deliberation that you are bullish on financial services, and we have also seen the bank's margins to normalize across most of the large private and PSU banks, where the profitability also had gone to the multi-year highs, right? So, however, what are the factors that could minimize the pressures on margins and also higher cost of funding?
Thanks, Indrajit. So I think first we need to differentiate between the structural and the cyclical factors which lead to this kind of margin. So I think it's better to focus more on the structural reasons and the structural factors rather than the cyclical factors which tend to play out over a year or two. So I think what happened last year was more cyclical in terms of RBI raising rates. So there are certain set of financial institutions which have a I mean, depending on the asset liability mix, some institutions benefit and while some don't benefit. And when the reverse happens, it plays the other way around. But I think structurally, what we are also focused and what as to answer your question, what banks or financial institutions can do, I think on the asset side, depending on the asset mix they have, whether it's retail, wholesale, secured, unsecured, I think banks and financial institutions try to play around with that mix and also not just cyclically or not just tactically, more structurally also try to have a better retail mix, which can lead to a higher yield and some bit of this pressure can be relieved. And again, on the liability side, where we are also focused on when we look at our portfolio and the holdings we have, basically banks which have much better liability franchise, much higher CASA mix, retail deposits tend to generally do well and are able to absorb the cost of funds increase better. So if you look at our portfolio specifically, we are trying to either invest in stocks where we think they have a good liability franchise and lower cost of funds, so that could be an advantage. On the other side, we are also invested in few NBFCs and banks where cost of funds might not be an advantage, but they have a asset mix such that they have a better pricing power. So the ability to pass on that cost of funds increase to their customers is much easier. They are in less, I would say they are participating in less competitive segments. So we try to basically invest in those kind of financial services institutions who at least have either of the one as a advantage, so that either they can absorb the cost of funds or they can obviously pass on the cost of funds to their customers.
Sure. Thanks, Vishal. So the next question is on IT. So the demand for IT services has likely weakened in the recent times, and also there is a persistent competition among the players, right? So how is the path to earnings expansion looking like, and also do you see any major catalyst of growth in the space?
So I think if you look at on a longer term, tech spends have generally globally tech spends have continued to grow at 3-4%, and technological changes are continuously happening, and technology is now getting more embedded in the businesses. So we believe that longer term global tech spends growth should continue, and Indian IT services companies are actually growing much faster because they are gaining market share. What is basic, but this is a more of a longer term picture. But obviously, year in, year out, what happens is that the corporates or the companies who are spending on tech also is also linked to their outlook on their own profitability. So as we already discussed last year, there was some concern in US on slowdown or recession. US companies had a, I would say, a weaker visibility on their own earnings, and obviously there was a temporary, I would say, a pullback on IT spending. So to answer your question, I think as and when that visibility improves, earnings visibility for the companies who are doing the tech spends, large US banks, large other US retail companies, and other companies, and not just US, across the worldwide, even in Europe or UK. I think because there is no impact, I would say, on the longer term IT or tech spends. It's just that near term, depending on their own outlook for their own profitability, companies will try to control the tech spend in that particular year. And as that visibility improves, I think the tech spending will again come back, which should help the Indian IT services companies.
Sure. One last question on the sector. So auto as a sector, and in fact, you have been overweight in this particular sector by 4% in focused equity fund. So very well placed at 10% in the portfolio, right? So what are your views on this particular sales and particular sector, and would you want to share any thoughts there?
Sorry, Niranjan, which sector?
Auto as a sector.
Okay. Okay. So, I mean, Niranjan, it's very clear that auto is a cyclical sector, and we saw it went through, the sector overall went through a 3-4 year period of down cycle, and it started pre-COVID itself, and then obviously during COVID it further manifested, and there were supply chain issues and lot of issues both on the demand and supply side. And we have already started seeing recovery in last 1 year. I would say more than 1 year, maybe 12 to 18 months, we have seen the recovery, especially on the four-wheeler and CV side. Two-wheeler, the recovery has been little more gradual, as because I mean, it is also linked to there is also another shift happening there towards EV, and rural has been not doing well, which has a higher rural. But we have started seeing recovery in two-wheelers as well. So I think, and we expect this recovery to continue ahead. On the margin side also, for our entire sector, there was a lot of pressures because of the whole input cost inflation and the negative operating leverage. Both are now favorable. The input cost pressures have gone away. A lot of input costs have actually gone down also, but incrementally there is no further input cost pressure. And on top of that, I think as volume growth comes back, operating leverage should also benefit the margins. So I think all in all, that way the sector looks good. Specifically to the positions which we have in focused equity fund, I think here we are trying to play both the cyclical recovery, margin improvement. Also, obviously, there are we have like one of the holdings which we have. There is also I think we believe there is a scope for significant deleveraging because they have debt, and I think as volume growth comes back, there could be a deleveraging, which could also help in obviously I think stock price doing well. So I think that is how we are looking at sector. But it's clearly a cyclical sector, and we'll closely monitor it.
Sure, Vishal, thanks. In the interest of time, I think we will take last two questions for this evening. So, Vishal, again, one last question to you. The focused equity funds could be highly volatile due to the underlying concentration in the portfolio, right? So, therefore, what is the investment horizon that you would at least recommend investors, and also what is the approach one should be adopting in terms of investing, either lump sum or SIP, and also what is the time frame that one can look at while investing in these funds?
Okay. I think firstly I would say that I mean, it's right that the category obviously is slightly more risky because of the concentrated nature of the portfolios. As I mentioned earlier, we try to reduce the volatility or the risk by trying to manage the fund with a blend style, not having a significant style bias on either side, either on growth or value. So that is one way we are trying internally to manage the volatility in the portfolio. Coming to the question directly, I would say, like we recommend for all diversified equity funds, SIP is a very good way to invest in this category. Even if someone is willing to, I think, interested in doing lump sum, I would say along with lump sum, doing a SIP is recommended. And again, similar to all equity diversified funds, I think one investor should come with a longer term horizon of at least, I would say, 5 years.
Yeah, sure. Thanks, Vishal. That was really helpful. One final question to Vetri. So maybe Vetri can conclude the session after this. So the question is: the Indian markets continue to witness rich valuation, capping upside expectations, especially in the mid and small cap space, perhaps. So, do you see any pockets where the fundamentals of the businesses continue to be favorable related to the current valuation in the pockets?
Sure, Niranjan. Yeah, and if you think of the market in terms of the market cap construct, large, mid, and small, then I think without doubt the part of the market which relatively looks better off from a valuation perspective compared to small caps in particular is the large cap space. So, in addition to some of the points Vishal made, I would say that within the UTI umbrella, actually the two most large cap oriented strategies that we run is UTI Master Share, which is of course the large cap category as per SEBI. But even our focused fund actually is completely biased towards large caps for a variety of other reasons, including the fact that we can only run a 30 stock portfolio. So those looking for a large cap bias strategy because there's more valuation comfort, relatively speaking, I think both Master Share and the focused equity fund actually are good alternatives to look at. Of course, if you break the market down, Niranjan, there will always be some sector where there is some level of relative comfort. I would say pharma healthcare is one place where we still don't find the valuations very challenging. I think companies are continuing to focus a lot on their own balance sheets, cash flow, putting the business house back in order. And I think that's typically a time where we'd be quite positively inclined to look at it. I think the whole not the whole, but particularly the global metal space. There's no good news over there, but then the valuations reflect the fact that there is no good news, and these balance sheets are in much better health than they used to be at any point in the last decade. So I would say, the metal space again is something where, from a valuation point of view, we think we can take comfort. Two areas which are more mid-cycle in terms of their current positioning. I think Vishal has talked about financials, and then, of course, in the past, we've also talked about the automobile sector. But I think these two are sort of mid-cycle. Their cyclical story is perhaps, not fully played out. Valuations are off the bargain basement levels, but they've not become so pricey as to, raise a red flag at this point. So that's sort of the construct of how I look at large, mid, small, and between sectors where the opportunity is. But obviously, when you run a diversified portfolio, you are exposed to, segments of the market which now clearly are, got valuation challenges. But anyway, thanks, Niranjan, for moderating this session. Thank you, Vishal, for covering the entire focused equity fund strategy. And thank you to all our viewers who've, come forward with their questions. That is what makes, these sessions useful for those of you who have asked the questions, and for all of you watching, because, hopefully this may address some questions or thoughts you had on your mind as well. So thank you once again for joining us on this edition of the Monthly Market Insight webinar. And we look forward to connecting with you again next month. Have a great evening.
Thanks, everybody.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.